Hi, friends. Welcome. At this point, I want us to take a look into leases. Don't worry about this, okay? It's just a letter card with a medication on it, so it's one of those things. So it appears interestingly, this is about the third time I'm trying to do this video. I'm hoping this will work because I don't know what is happening with the system. All right, so we'll go to leases. I'll try and see if I could break it down into two parts. If not, we'll just go for one full swing. All right. And I'll take my time and see where we can make some good progress. All right. So I share my slide and then we move on. We kick off. All right. Good. Lease accounting IFRS 16. And when you look at the online page, I've plugged in a detailed guidance note from PwC issued in 2016. But I think it's very relevant today. Very, very relevant. IFRS 16. You may want to review that article on the site. Okay, so at the end of the day, when you go into any leases, there's what we call the right of use assets and the lease liabilities. Simply, you've acquired an asset, you have the right to use it. That's why we use the right of use asset, but it's still an asset. Okay, it's still an asset. And then we have the lease liability. We look at exemptions from the recognition criteria for leases in the records of the lessee, the one who is acquiring the property. Then we account for any lease and sale back agreement. If it amounts to sale, what do we do? If it is not a sale, if transfer has not been complete and control and ownership has not been transferred to the other person, what do we do? Okay. Of course, you can even tell off head. If it is a complete sale, just de-recognize the asset from your books, the one who is selling it, all right? Any questions you encounter around this, you should be able to work it out. Okay, so all that I've said in the learning outcome is what we've seen here in the overview. Okay, so lease accounting on its own, we'll be looking at the lease liability and then how we can split it between the current and the non-current, the one which exceeds more than a year, but the one that is payable within the year, within 1 year, we capture it as current. Usually, we'll calculate the non-current and the difference will be the current portion. Okay. Then we look at lease and sale back. If it's a sale, if it's not a sale, what do we do? All right. So a lease in its own, in terms of definition, technical definition provided by the IFRS 16 Appendix A says that it is a situation where a lease is normally a contract that conveys the rights for somebody, a company, an individual, possibly because we all lease. We go for hire purchase vehicles, we go for mortgages. There are all types of leases. Okay, it gives you the one who is acquiring this property to use and underlining that asset, to use that asset for a period of time in exchange of for consideration that you pay. Okay, we have the lessee and the lessor. The lessor is the owner who is now transferring the rights to you to use the property, and he gets something. He gets money, right? The lessee is the one who wants to use this property and he pays something. He pays money. He pays consideration. All right. The right of use asset is the underlying asset. It's an asset that I have the right to use. That's all. Okay, those are the terms, not anything technical. Just we're using those technical words for us to be able to understand and apply them in context. The inception of the lease will give rise to two items, the lease liability and the asset that we use, the asset that we have right to use, okay, the right of use asset. Now, the lease liability is actually recognized as the present value, okay. So once we're talking of present value, it means we are surely going to be discounting the future payments, okay, the future payments that is required of us, okay, future payments. So you go and, for example, you want to take a mortgage. The mortgage you're going for 250,000, for example. All right. This 250,000 that you'll be paying over the period, you should know that 250,000, assuming you are paying it over 20 years, it will not be the same in 20 years. 250,000 today is not the same as 250,000 20 years. It will be lower today. Okay. So what we have to do is to discount this 250 to a present value. Okay, to a present value. We'll take an example and you will understand. So simply these 250,000 times the discount factor. Okay. Normally, you look at the market rate, the discount rate, or the interest charges that they are placing on this mortgage, and then you use it as your discount rate. So you surely will end up getting your 1/1 plus the rate, right, to the power n. And you multiply it against your 250K to get your what? Present value of the payments. Okay. Now, this present value, besides the discounted figure, okay, includes any fixed payments. Every month you pay 500 to the to the car that you're going to lease, the owner, to the lessor, to the mortgage provider. Every month you pay a certain amount. Okay. It also includes any amounts expected to be paid under any residual value guarantees. Okay, you could normally have those residual value guarantees, and we are expected to pay a certain amount. Okay, and again, you could also see, and you see those of you who have high purchase car, they will tell you option to buy, option to buy. Normally, very small. Okay, they will give you £1 option to buy. It also includes that present value. Okay, and any termination penalties, you try to terminate the agreement before the due date, you pay some penalties. They tell you pay some 5% of the outstanding amount or 2% of the outstanding amount. These are all part of the present value. All right. All right. Now, the right of use usually is an asset. So recognize it at cost. Okay. It's an asset. Recognize it at cost. Initial recognition. Okay. So initial value of the lease liability that you know you have to pay. And then also it must include payments made at the beginning or before you commence the lease agreement. That's the asset. So sometimes they'll tell you there's a direct cost, a deposit of 3,000. You have to include it. And then you know you are supposed to pay 23,000 for the rest of the period. So the 23, the initial value, plus the 3,000 direct cost. Okay. Now, together with any acquisition cost, which we normally capitalize as the right of use of assets, like I said, any initial direct cost could be a deposit. Any estimated cost of removing the assets or dismantling the assets as per the lease conditions. It could even include installation of the assets. Should all be part of the cost that we capitalize. All right. Now, for financial reporting purposes, it's likely that this lease liability will simply comprise the fixed payments that you are required to pay every year, every month. Okay, if you are preparing it on monthly basis, but usually we deal with yearly. And then the value of the right of use asset would equal the lease payment plus any payments at the commencement. We'll take examples, so you'll be fine. All right, I'll split it into two parts so that hopefully this video doesn't get corrupted again. All right, now let's take one example and then we'll continue on the other end. So on 1st January, Dynamic entered into a 2-year lease for a lorry. Okay, we are told that contract contains an option to extend the lease for a further year, one more year, 3 years in total. Dynamic believes that it reasonably will exercise this option. So I'll exercise it. Lorries have a useful life for 10 years. The lease payment is 10,000 for the initial term. What is the initial term? The 2 years. And 15,000 per year for the option period. Okay, the option period there. The 15,000 for the extra 1 year. Okay. All payments are due at the end. So payments are at the end. So we have to accrue whatever interest on it. Then these guys will cause us to pay the payments at the end. To obtain the lease, Dynamic incurred initial direct costs. We include it as the cost of capitalization. The borrowing rate is 5%. It means we have to now go and discount the future payments to the present value. All right. We'll discount it for the first 2 years. The third year, okay, we'll just discount them. All right. Let's calculate the initial carrying amount of the lease and then the right of use assets and provide these double entries in the financial statements of Dynamic Limited. All right. So you realize that for year one, okay, year one and year two, it was 10,000 and 10,000. For year three, we are told that the payment will be 15,000. And he said, I'm sure I'll exercise this. Okay. So let me now discount the whole of this 10,000. So this times this gives you this figure. Okay, I could have just brought the discount factor here or the discount factor here, but I decided to expand it to leave it this way. Okay, if you try your tables, if you have a discount factor tables, try 5% for year one. Okay, and you should get a certain figure on the table. If you want to use 2 decimal places, that's okay. If you want to use 3 decimal places, that's okay. All right. Now, what I'm going to do is I'm going to try. Okay, something is happening to my calculator, and I don't know what it means. Okay, start. Yes. Interestingly, my calculator is. Oh man. All right, I'll leave it. I'll leave it. Fine. You can always calculate this. Okay, you can always calculate this, and you get this figure. At the point when you need help, everything just messes up. Everything just messes up. Okay. So this is a discount factor. You can easily calculate it with your calculator. Okay. And then when you multiply 10,000 by this discount factor, you get this. 15,000 times this discount factor, you get this. Sum them up, and this gives us a present value. Okay. Is that all? Is that all that we need to recognize? This is a present value. But you can see this does not include the direct cost. Okay. It does not include the direct cost. So the direct cost will need to be included, okay, or added to be able to recognize the cost of the asset. So the initial cost, which we have calculated the lease liability, is this. Add the 3,000, and this gives us the right of use asset, which we must recognize, okay, which we must recognize. The double entries usually will be the right of use. Okay, 31, the initial liability should match with the liability once again. Okay, but then we have to debit the extra 3,000. Remember, this was already paid through cash or bank. Okay, so no need for us to have a credit entry in the lease liability. It has been paid. Unless it's accrued somehow, then we can capture it somewhere as part of the lease liability. So the total right of use asset is this. Okay. Sometimes you could also represent the whole of this to be what? Let us what? Debit the right of use asset. Okay. With what? 34,552. The total. And then we credit what? The lease liability. Okay. You credit the lease liability of 31,552. And then you credit the cash or bank, which we paid out 3,000, and it balances. All right, this is it. Very easy. There are always interest charges that we need to incur because they tell us that this will carry some rates, some interest rate that we pay along the line. So the interest charges, the finance cost, and the lease liabilities are best calculated when you use a lease amortization schedule or a lease liability table. Some call it the lease amortization. Okay. So anyhow you want to call it, it's a table which will represent the payments, the initial value, the payments which are due or which have been made, any interest charges, and we get the closing balance. Okay. Usually you see questions examining you on this to prepare the lease liability table. It's important that at this point, if for nothing at all, we should know how to calculate the lease tables. Okay. We'll take 2 steps, okay, and then we wrap up and we'll come back in the second segment. Okay. The liability is increased by any interest charges. We know. Okay, so the liability will debit the finance cost in our statement of profit and loss, and we credit the lease liability with the interest component, the same amount. Okay. Whenever you make any cash payment, cash or bank will reduce, right? So we credit cash and bank. And then we also reduce the lease liability by the amount which we have paid. Very easy accounting entries. Now, it could happen that we pay in arrears or we pay in advance. If you are paying in arrears, what do we do? So there could be 2 things. When you are reading the question, take note. Are we making payments before or right at the start of the year? Or are we making payments at the end of the year? If it is at the end of the year, then your liability would have accrued some interest, okay, before you make the payments at the end of the year. But if it is at the beginning of the year, then it means you have reduced your liability before the interest charges comes on, okay. So let's assume in 2014, okay, let's assume that ABC Limited, okay, in 2014 had this 24,000 as a balance brought forward for the lease liability. And there was an 8% interest charge on the 24,000. It gives us 1920, right? Then they paid 7,250. So you could see that this plus this gives us a certain answer before we subtract the payment, which gives us a net figure. It means we pay in arrears, okay? We pay after the interest has accrued. What about if, for example, let's say Bill Limited, in 2014, the same guy, the same year, they also have a lease liability brought forward, okay, of 24,000, and then they make an initial payment of 6,850. So they pay in advance. So their net balance becomes this. Subtract this from this and you get a net balance. Before the company or the lessor charges an interest of 10% on it, added, and he gets a net figure of 838. Forget, don't worry, because we're using 8% and we're using 10%. That's why the figures have changed. Okay. Friends, I'll end here and then we'll look at the subsequent measurement of right of use asset. Okay, as our next part of the slides. I don't want to keep it long because the longer ones have corrupted. So maybe I'll keep them in 2 bits. So I'll see you in the next session. All right. Thanks for now. Bye.